Hello friends, subscribers and colleagues, a warm welcome back to Readings in Impact Investing. My name is Daniel Rosehill. This is a brand new podcast I set up a few days ago with a YouTube channel as a distribution destination as well. And the aim here is to take dense material in the world of impact investing and make it a little bit more accessible through reproducing it in the format of audio. This podcast is available now on its own website, although it's not yet. It's a redirect for the moment, but eventually will be a website. That URL is readingsiниmpact.org. That's readingsiниmpact.org. Just want to state at the outset, this is a not-for-profit initiative. I just set this up because I think it was something that was really needed. I personally find myself reading a lot of these reports, and I often am at the gym thinking, hey, it would be great if I could just listen to them. There's probably some really smart way to do that with all the text-to-speech solutions on the market now. But I said I'd do it the dumb old way of just me literally reading off the documents. And it's usually just me reproducing the material, but sometimes I add in kind of glosses and notes of my own. Final sort of housekeeping note is that my contact email, because we're at the very initial stage of this progress, of this project, which will be taking place really throughout 2024. My email is public@danielrosehill.com. That's ROSEHILL. Do feel free to drop me an email if you think, hey, this would be good to read on your podcast. I do always attempt to check with the content authors to make sure that I can do this, but it's always going to be stuff that's in the public domain, at least for the moment anyway. So in the last episode, we took a look at Catalytic Capital, and I read off the webpage of Catalytic Capital Consortium, C3, as well as the MacArthur Foundation. And then I was thinking, well, you know what? If we're talking about catalytic capital, we should really talk about blended finance. And I was going to do one about blended finance, and I said, why not do the difference? And that got me thinking, how do I explain the differences? A little bit of time on Google led me to this LinkedIn post by Kusi Hornberger, who is partner and global management lead at Dalberg. And he has this LinkedIn article that I thought was terrific called The Rise and Importance of Catalytic Development Finance, and I think it does a great job at explaining the distinctions here. So I'm going to go through it slowly because it's very important. So this is Kusi's article. The term catalytic capital has generated considerable buzz in the impact investing and philanthropy communities in the last few years, largely due to a series of grants from the Catalytic Capital Consortium, or C3, the organization that both coined the term and that has subsequently worked to demonstrate and support use of the concept. So just to refresh on what catalytic capital is, we talked about catalytic capital being offered at concessionary rates, or basically supplying finance to developing economies or impact entrepreneurs in locations that would be usually considered too risky or too unattractive for conventional finance, right? And the catalytic aspect of the terminology that I think is really clever is the idea that, well, sometimes if we can just get the ball going, if we can have a first tranche of finance come in that is catalytic and taking on a risk that would be considered too high for conventional lenders, then the conventional lenders can follow. So that's the concept of de-risking. So that is, and basically coming back to the catalyst analogy or metaphor, I'm not sure, image perhaps, is that this initial wave of capital is kind of the catalyst for that second wave of capital and subsequent waves to come in. So I'm going to continue now with Kusi's article. Yet the approach behind the term remains poorly understood, specifically how it relates to other types of blended finance with philanthropic or donor support. C3 defines catalytic capital as capital that accepts disproportionate risk or concessionary returns to generate positive impact and to enable third-party investment that otherwise would not be possible. And although this makes catalytic capital sound akin to blended finance, the approaches differ in essence. Okay, now we're going to get to the really dense part of the article. So listen carefully. While all blended finance approaches use catalytic capital, not all uses of catalytic capital can be considered blended finance. Ooh, that's a tricky one. So let me read it again. While all blended finance approaches use catalytic capital, so catalytic capital is integral to blended finance approaches. However, not all uses of catalytic capital can be considered to be blended finance. And we're going to see in Kusi's article examples of where capital could be described as catalytic without being part of a blended finance initiative. Convergence, for example, the leading intelligence platform on blended finance, considers a transaction to be blended only when catalytic capital attracts private financing into the structure's capital stack. Convergence also requires that catalytic capital financing be concessional in its pricing, for example with below market rate returns. Convergence does not account for or consider other types of catalytic activities, however, such as demonstration effects or facilitating innovation. And it's those other types of catalytic activity that Kusi mentions here, demonstration effects or facilitating innovation, that we're going to be talking about, just to make clear what the difference is exactly between catalytic capital and blended finance. Just to kind of refresh where we're at now, the catalytic capital is fundamental to blended finance, that if it's blended finance, we're talking about some catalytic capital followed up by conventional investment, but there are types of catalytic capital that aren't blended finance. So let me continue here. Using the C3 definition and looking at the Convergence database of historical blended finance deals, we see that use of catalytic capital has achieved an annual growth rate of 26% over the last 20 years. And let me just make note, because this field is so quickly advancing. In fact, I think the definition that the C3 use has actually changed since this was released. This article was authored on October 25th of 2021. So a couple of years old at this point. Another mistaken belief about catalytic capital is that it comes only from private foundations or donors looking to de-risk others in the transaction. Few realise that a large share of catalytic capital also comes from DFIs, development finance institutions. In 2020 alone, $303 million worth of concessional financing was provided by DFIs to de-risk or sweeten 24 deals for other investors. That's a term I haven't seen as much, sweeten. But that actually makes a lot of sense. That just explain what de-risking is, right? That these guys are coming in at the concessional terms, or accepting this, or both. In fact, they could be both accepting bad terms and high levels of risk, which is a sort of picture that would not make sense at all for conventional investors, and sweeten the deal as such for others to say, okay, it's less risky now. You can come in and do your conventional investing in this market. Thereby, they have thereby catalyzed that market. So, how do DFIs provide catalytic capital, and what might this mean for the future growth of its role in DFI's plans moving forward? Some quick insider research reveals 3 archetypes for DFI use of catalytic capital that I believe are worth sharing, so others may learn from them and replicate their results. Demonstrate, de-risk, and enhance impact. Each is described below with examples. Example 1, demonstrate the potential of a new investment thesis. In 2016, Pomona Impact, a new impact investing fund with first-time fund manager, was created with a focus on investing in Guatemala and Central America. As a first-time fund manager, the founders had difficulty raising capital. Pomona invested $1 million of friends and family money and was able to obtain a catalytic loan of $1 million from the IDB Lab at favourable terms with concessionary rates. The IDB Labs loan was instrumental to getting the pilot fund to critical mass and provided Pomona with the opportunity to demonstrate that it could make sustainable impact investments in the region. 2 years later, the pilot fund was considered a success, investing in organizations like Ecofiltro, Uncommon Cacao, and Yellow Palette. Based on this demonstration effect that impact investing in Central America was feasible, the Pomona Impact team has now successfully raised and launched its first $20 million fund, currently deploying capital into high-impact social enterprises across Central America, with more than a dozen investors, including DFIs and private source of capital. So basically, Kusi's calling this a demonstration effect. In other words, this wasn't a blended finance deal from the outset. It wasn't like there was this catalytic capital and conventional finance all being kind of bundled together through this blended finance vehicle. It wasn't at the same time. What's the word I'm looking for? Simultaneous. It was step by step. There was firstly this concessional capital showing that this model could work, right? And he calls that an investment thesis. I would call it a model. So that again is an example where this was not a blended finance transaction, but this was undoubtedly catalytic capital. Number 2, de-risk to better serve the needs of difficult to serve social ventures. Traditionally, due to perceived and real risks, agriculture has been considered a difficult segment to finance. Our own analysis shows that providing loans to ag SMEs, agricultural SMEs of below $1 million is difficult to do profitably. We also know, however, that safe, reliable, environmentally sustainable food systems are critical to our shared prosperity. To respond to this urgent situation, Incofin, a fund manager based in Belgium, has introduced the Fair Trade Access Fund to serve the financing needs of smallholder farmers and ag SMEs by investing in fair trade certified organizations and cooperatives in Latin America and Africa. To make the fund financially viable and to attract private investors such as pension funds, commercial banks and corporates, the FAF used an innovative blended structure with 2 share classes and the possibility of leveraging up to 1 time. These 2 share classes attract investors with differing profiles. Class A shares have a 7-year lockup period, thus attracting investors with a long-term development focus, principally DFIs, and Class B redeemable shares attract private investors. The FAF has been a big success, having now made $128 million in disbursements and impacting more than 372k smallholder farmers' livelihood through 10% increases in productivity. Without initial dure equity financing from the FMO, these investments and thus these farmers' livelihoods might not have had access to those opportunities. So he calls this a classic case of de-risking. And finally, enhance the impact potential of investments with technical assistance. The Dutch Good Growth Fund, DGGF, is publicly funded by the Dutch Ministry of Foreign Affairs and privately managed by Triple Jump and PricewaterhouseCoopers PwC. Since 2014, DGGF has been providing a combination of catalytic capital, capacity building and ecosystem development to bridge the financing gaps for small and medium enterprises in emerging markets. DGGF provides catalytic capital via its fund of funds to mezzanine, private equity and venture capital vehicles and concessional debt to upscaling microfinance institutions and digital lenders. Between 2015 and 20, DGGF committed €324 million via its fund of funds to more than 60 local finance providers and €37.6 million committed by the Seed Capital and Business Development Facility into 20 local finance providers and more than 10 entrepreneur support organizations. So that's another example there where what's catalytic is that it's going into not necessarily finance, but these entrepreneur support organizations or ESOs that have been proven to be incredibly effective in making finance better or improving the governance of money received in these developing economies. You know, the previous example of these smallholder agricultural businesses. As these examples show, it is not only possible but critical that DFIs continue to provide catalytic capital. DFIs that invest concessionally and prioritize market building and innovation can achieve the greatest impact. If a DFI hesitates to take this route, one natural means of scaling up is to pair the activities of bilateral donor aid and agencies with bilateral DFI support. So I've just skipped a couple of sentences there because they don't really add to this particular episode. But I hope that's made clear that catalytic capital and blended finance are not exactly synonymous. The catalytic capital is integral to blended finance, at least in the majority of definitions. But there are examples of goals that catalytic capital seeks to undertake that are not necessarily blended finance because they're not part of a blended finance deal. They are there to just to go through the headings again, to demonstrate the potential for a new investment thesis, to show, hey, this idea can work, right? We're not gonna seek other financing yet. We're just going to show that this idea, if we provide capital into this market, that we have an investment idea that can work. Secondly, classic de-risking to better serve the needs of difficult to serve social ventures. And finally, enhancing the impact potential of investments with technical assistance. And again, we look there in that example of entrepreneur support organizations or ESOs getting the money so that the overall ecosystem being funded would work more effectively and, I think very importantly, ultimately be less risky, so that when other capital comes in, these businesses have experience in managing their SMEs and being upskilled and uptrained to be more responsible borrowers and therefore less risky borrowers from the perspective of lenders. I hope that was useful, this episode on the difference between blended finance and catalytic capital. Thank you to Kusi Hornberger, the star of the show, whose article I read from and quoted from here. And if you'd like to get more episodes from Readings in Impact Investment in investing, do please consider sharing around readingsiниmpact.org with your colleagues, or subscribe. Feel free to do both on Spotify, Apple Podcasts, Google Podcasts, and anywhere else you like to get your podcast. Thank you for listening. This has been me, Daniel Rosehill, wishing you a very good day.